Grain futures have trended lower since USDA March U.S. and world supply and demand report. Will the lower price trend continue? Is this a good price for end users to add to coverage?
We have seen the grain markets futures contracts trend lower after the USDA's March 9th supply and demand report. USDA basically made no changes. The market was looking for some maybe lower South American crops that would increase U.S. exports and lower our carryouts. But there was little change. Now the next thing will be where do prices go from here? And I think we're in a broad trading range with nearby beans maybe $13.50 to $14.50, maize at around $14.10, corn $5.20 to $5.60 with the May around $5.45, and wheat maybe $6.20 to $6.80 with Chicago May wheat at $6.43. Is this a good level for consumers to coverage? I think in the wheat there's a lot of coverage already through June. It's really hard to buy corn for the summer and meal for the summer, but I think we could lock in these price levels and possibly hedge against a possibility of some adverse weather conditions either here this summer or in Russia.
What are the next key fundamentals for grain price action?
There could be quite a bit of fundamentals that affect price over the next 90 days. I think the first thing we'll have to do is get a handle on the size of the the South American crops and how much exports they're going to put out. And that will tell us how much our exports will be and what our carryouts will be. I also think that we need to watch pretty closely Thursday's U.S. and China trade talks in Anchorage, Alaska. The Chinese could buy some U.S. ag goods before the meeting, but more importantly, we'll see if there's any compromise in that they say that they'll buy what the agreement of phase 2. In return, U.S. lowers the 35% tariffs on Chinese imported goods. I also think that the March 31 USDA report is critical. We'll see what the farmers' intentions are in acres by crops and March 1 stocks. Any lower number of corn or bean stocks than the average trade guess could help spreads, could help basis, and could help futures.
Will managed funds add to positions following increased in grain position limits?
The CFTC increased almost by 70% the position limits in the grains. Last couple of weeks, some people thought that they would come in today, March 15th, and add to their long positions. But better weather in South America, good weather here in the United States, and kind of some uncertainty as to whether the market needs to rally or not may reduce them adding to their positions until that March 31 report. Now we have the outside markets, the stimulus package, and is that good for the economy or is the increased debt bad for the economy? And then we have the vaccination, and will that open the economy and allow increased demand for food and fuel?
What will the Federal Open Market Committee say at the conclusion of its Wednesday policy meeting?
There is increasing pressure on the Federal Reserve to limit upside pressure on longer-term interest rates, especially after the European Central Bank last week said it will ramp up the pace of its purchases of Eurozone debt. Also, we had the Reserve Bank of Australia earlier this month increasing the size of its asset purchase plan. So I do believe that major central banks, including the Federal Reserve, will eventually employ tools to mitigate rising long-term interest rates. And I think at the upcoming Fed meeting, the Fed will either hint at buying more assets or actually announce more asset purchases. So probably hint, if I had to guess, of more asset purchases. But either way, I think the Fed will mention it, and I think they will become, at one point or another, more aggressive in their asset purchase plan.
What is the U.S. dollar outlook?
Interest rate differential expectations are offering no clear advantage to the U.S. dollar. So I think that we will probably see the dollar index remaining in a trading range between the 90.60 to the 92.55 area. And I do see breakouts probably failing in both directions for the dollar index.
Will rising long-term interest rates halt the bull market in stock index futures?
So I do believe that rising long-term interest rates will probably only slow the advance in stock index futures and not reverse it, especially if I am right that the Fed and other central banks are on a course toward, in one form or another, limiting upward pressure on interest rates. So it still looks like the trend is higher for stock index futures.